Yeah, Shrikant, you had a doubt here, right?
Yes, sir.
See, as I said, each business unit will have its own master data objects. That was your doubt, right? Whether only the corporate view will have the master data objects. What was your
Yes,
doubt
ma'am.
exactly? What was your doubt, Shrikant?
Only corporate BU contains master data or
No, 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 no,
individual.
no. It's each, excuse me, each BU will have its own master data objects. Okay, which wherein the corporate BU, which is a shared service center, will get an access, okay, to your master data object, because this is taking care of the rest of your business activities, right? Like the HR, the procurement, and the administration of all these BUs. Suppose if this BU1 was doing all its own business functions of, doing your procurement, your HR service, and corporate administration, there was no need for corporate BU. It would have, its own different departments. But when it comes as an overall, for BuddyPower Corporation, you get more discounts on your corporation, procurements. You'll have less number of employees, okay, wherein you need not employ, you need not what do you say, sorry, one second, yeah, you need not hire employees for your each business unit. It's a cost on the company itself, right?
Ma'am, it will act
Yeah.
as a consultancy service like that, no, ma'am?
No, no, ma'am, it's not a consultancy service. Even this is part of a legal entity. They are
Okay,
just
fine, ma'am.
sharing their, what do you say, just to, reduce your cost. The
Okay.
corporate BU will take care of your other process or other transactions. I mean, so the process of
Okay.
whatever business
Under this
activities that you're
umbrella,
having.
that other units will be taken care.
Correct, ma'am. This will be called as a client BU to the corporate BU.
Okay, fine.
Okay, so they basically share the services. I mean, this has access to, do all the functions of, say, like your payment to your warehouse, suppose if you rented a warehouse, okay, where your
Okay.
pharmaceutical, your medicines are stored. This BU is taking care only of your sales, ma'am. In UK, it only takes
Okay.
care of your sales, wherein its its main function is to see that the medicines have been sold out in the country
Okay, fine.
UK. Okay, so now suppose, just for an example, if I say they don't have an HR department there, so who is going to pay
Okay, fine.
salaries, who is going to take care of all your employees details? That the
Okay.
corporate BU will take care.
Okay, fine, fine.
Okay, fine, ma'am. Yeah. Okay, so let's move to the reference dating, Shira. So as I said, there are two seeded RTS, that's reference data sets, which is the common set, which allows the master data objects across all BUs, and the enterprise specific. Now, suppose imagine this is a shared service center BU. Okay, this user is sitting in the shared service center BU. It has an
Okay.
access of a common set, wherein it can have the access of the master data objects of, say, country Tokyo, Paris, and Berlin. This also has of its own, okay, it has its own unit access as well, okay, which is the UK location set. It can access into London, Oxford, and Cambridge business units master data objects as well. Okay, so this is under shared, this is what is the reference data sharing is, ma'am. I'll give you another example to make this more clear. Okay, this is a set assignment. See, for example, there is BU, the three BUs named as US1, US2, US3. Okay,
Okay.
so here the reference data object is accounts receivable payment term, okay, for
Okay.
each. And you
Okay.
have the reference data set name as US1 set, US2 set, and for the US3 you have set it as common. Okay, this is a reference data set that you're given to three business units. Now this is the reference data set name and the AR payment term, ma'am. Okay, so here US1 set has a net 30. So now this net 30 means, okay, you have to make a payment within 30 days, okay, after the invoice date, from the invoice date. Okay, so say today is 31st, you have to, today is the invoice date, and you have to make the payment within the next 30 days.
Yes.
Yeah, so that is what is called as the net payment term. Okay, it's basically the payment which is due 30 days after your invoice date. Okay, so now US1 set has an access to net 30. US1 set has an access to net 45 as well. And there is a common set which is net 30. Common meaning all the three business units can view this, can view the payment term. Okay, and there is another common set which is immediate, wherein you have to make an immediate payment. Okay, and US2 set has an access to net 45 and US3 set is net 30. Now, ma'am, can you, anybody, Shrikant, Ravi, and even Shankar, sir, can you tell me what is, the user under business unit US1, which all data can he access? Which are the payment terms that he can access? Anybody, anybody? Yeah, net 30 and?
Net 30 and net 45 we can access. US
Yes,
set one.
correct. And ma'am, anything else?
Net
And
30,
then
ma'am.
common data also access that net 30.
Correct. So net 30, net 45 and anything
Net
else?
40 immediate data.
Correct, ma'am. Good. Good, ma'am. And what about US2?
US2 that have access to the net 45 and net 30.
And ma'am, anything
And
else?
common net 30 and immediate.
Correct, ma'am. Common net 30 is anyways given to US, this one, yeah,
US set one.
correct. Is even net 30 is common and it has access to net 45 and one which is immediate under the common set, right? And what about US3?
Okay.
US3 net 30.
US3 is a common thing. US3 can access
Yeah,
net 30 and
yeah,
common net 30 and immediate they can access.
correct, ma'am. Okay, now you understood how the reference data sharing works?
Yeah, ma'am.
Yeah, okay, fine. So let's move to the next slide. Invoicing. Okay, so what is an invoice? What is an invoice in general terms? Anybody?
A receipt, basically, like
Receipt is something which you get when you're receiving goods, right?
so
That's an
invoice is
acknowledgement.
before.
Yeah.
This is like acknowledgement.
Invoice
Yeah.
is invoice is a billing which is done after the what we can say that delivery is over.
Yeah, ma'am. Correct. It's given by the supplier.
It's a
Correct,
final
ma'am.
billing.
Exactly.
It's a final billing.
Correct, ma'am. Correct. Yeah. In basically in common terms, it's called as a bill. And this is a list of goods, which are goods or services provided, by the supplier. And this is a statement of the sum due for those goods and services provided by the supplier. This is usually sent by the supplier. Correct, ma'am. Yeah. So anyways, these are the different types of invoices that we have, which is a standard invoice. As you know, standard invoice is an invoice where the supplier, represents an amount which is due for goods or services that has been purchased by the company. So standard invoice can be matched to a purchase order. Okay, so after matching, they'll clear the payment, right? Then is your credit memo.
Credit.
Yeah. Credit memo is one which is sent by the supplier to us, okay, to reduce the supplier balance. Like generally, credit memos are used by the supplier when we get discounts, on payables, or if there is any, price differences. Suppose if you have already, made an advance payment, an extra payment, sometimes it happens, right? So in that, they send a credit memo and you can enter only negative balances through your credit memos. Okay, so this is usually sent by the supplier. Okay, right. So next we have the debit memo. Now this debit memo is generally the one which is sent to the supplier in case where the company is not satisfied with the goods or services that the supplier has provided. Okay, it is not as per the company's expectations. So that is a time wherein the debit memo is sent by the company to the supplier. So this is also usually used for purchase returns. Okay, if there is a damaged product, okay, and, the products are not as desired as or not as per the expectations and all that. So even in debit memo, only negative amounts can be entered through your debit memo. Same here is the case wherein you could have made an extra payment. So you'll have to reduce that by making a negative entry. Okay, so that was your debit memo. Next comes the expense invoice. See, when employees spend the amount, okay, for your for the business function, they submit the bills for reimbursement, right? So that information the company must maintain as an expenditure report in the system, which means an invoice representing an amount due to an employee for business related expenses, right? So like for example, there's a sales guy who has to go and do his promotion of a particular product, so he has to visit different districts. So during that process, what happens, he has to incur, he has the travel expenses, the boarding and the lodging and all that. What he does, he'll pay from his money. When all that work is done, when he's back to the office, he'll submit all those bills for reimbursement, right? So that is the expense account for the company, the expense invoice for the company. So the company will later on, depending on whatever the expenditure amount is, it releases to the employee. Okay, so that was your expense invoice. And then we come to the retainage release. Okay, this is basically an invoice created for complex work and advanced contract financing. So basically your retainage means retaining certain amount of money with us, okay, without paying the supplier in full. Okay, so this retained amount is released or paid to the supplier only when all the terms of the agreements have been met or all the work is completed. Okay, say you have a retainage release with say over a period of say 6 months. Okay, and you agree upon making a payment, say 90% of the payment by say after 4 months. Okay, and the remaining 10% of the payment you'll make it only after the completion of 6 months. Okay, so this can be so you are actually retaining a certain amount, okay, depending on the agreement that you have with your supplier, right? So you clear with this retainage release invoice? Hello?
Yes, ma'am.
Yes.
Yeah.
ma'am.
Okay, fine. Then you have the withholding tax invoice. So this is an invoice where you enter to remit taxes, okay, with remit taxes that is withheld. So remittance basically refers to money that is sent or transferred to another party. Okay, so this invoice is basically you enter to remit taxes withheld for the appropriate tax authority. This is a this invoice, the withholding tax invoice, is usually the system will automatically create a withholding tax invoice. Say you may be required to withhold tax from your supplier invoices and pay it to a tax authority on behalf of the supplier. So you will set a withholding tax option on the supplier's setup page, okay, under the manage tax reporting and withholding tax options. Now, let me give you an example. Say if you have an invoice of rupees 10,000, okay, and you have set this withholding tax option, then this invoice will have a withholding tax of rupees 2,000. Okay, say for example, the invoice is of rupees 10,000, which has a withholding tax of rupees 2,000. Now the Oracle Fusion Tax creates a withholding tax type invoice line for rupees 2,000. So the withheld amount is rupees 2,000, which will be there with the company, okay, which the company will be paying to the tax authority on behalf of the supplier. And the remaining balance of rupees 8,000 will be paid to the supplier. Okay, so this is the withholding tax invoice. This you will come across under the tax once we go to the tax module, right?
Ma'am,
Yeah,
I have
yeah.
one doubt. Whether it is included in the invoice or it will create a separate invoice for paying this
No,
tax.
ma'am. This will be included in the invoice because you'll be enabling that
It
under
is not included. We have to
yeah,
raise
ma'am.
that tax
Correct, ma'am.
invoice.
Usually you have a option there, ma'am. You'll be enabling that withholding tax option there. There is a
Okay.
supplier setup page. Okay, wherein you will enable that particular option of this comes under the managed tax reporting and withholding tax option, so you'll be enabling that there. So automatically
Okay.
you'll put the conditions, ma'am, there. You'll be defining all the conditions and rules there. So it automatically, like an example, I said, for rupees 10,000 for that particular supplier setup page, you will put a condition saying that, okay, I need to withhold tax of rupees 2,000 and
Okay.
remaining will be released to the supplier. Right,
Okay,
ma'am?
fine.
Okay.
Yeah, ma'am.
Okay. Then you have this mixed invoice. Okay, wherein this is an invoice type where you enter for matching to both your purchase orders and invoices. Say in other words, your mixed invoices, which can have either positive or negative amounts, and this can be matched to both your purchase orders and invoices. Okay, say for example, there's a mixed invoice of negative 1,000 rupees. You can either match it to an invoice with negative 1,000 rupees or to a purchase order with an amount of 1,000 rupees. I know you'll get confused with this. This is basically, see, these are mixed invoices are used wherein, there is a data entry mistake which happens. Okay, or maybe the supplier has made mistakes and he has, sent a wrong invoice, or you have the company has, entered wrong amounts. In that cases, to make those adjustments, you select the option of mixed invoice and rectify the errors there. Right? That is the function of mixed invoice here. Got it? Okay.
Okay.
Okay, ma'am. Okay. So next is your recurring invoice. Now, a recurring invoice is one wherein a particular invoice is generated at a specific period of time, or automatically by the system. So a recurring invoice becomes useful when scheduled payments are to be made after a specific period of time. Say, for example, your rent invoice, okay, which you need to pay on each month on a monthly basis. So you would do one thing, you actually define define that as a recurring invoice, and every month it will raise, the invoice will be raised, and rent will be made to your particular owner, or whichever building, if you have rented it out, that will go to the building owner. Okay, so these are your recurring invoices. Fine. Okay, then we have the prepayment invoice. So this is a type of an invoice where you enter to pay an advance payment for the expenses to a supplier, or your, say, even for your employees. Okay, you can apply the prepayment to one or more invoices. Let's say, for example, you need to pay a deposit on lease. Okay, or you may need to pay an employee on advance for travel expenses. So you make a prepayment invoice. All right. Even in a prepayment, you basically have your temporary and permanent prepayment. So your temporary prepayment could be where you can use a temporary prepayment to pay a hotel, as a catering deposit. Suppose you're conducting a seminar or something, and you need to, order food, for certain all your employees for that particular day. So what you do is you make a prepayment invoice to the hotel, okay, as a catering deposit. And when the hotel invoice arrives, you apply that prepayment to the invoice to reduce the amount you have already paid. So basically, this is an advance payment that you've given to your
Just like a
supplier.
suspense account.
No, ma'am. Suspense is something where you don't know, and there are certain say transactions which happen that will be settled at the end of the period.
Okay.
Yeah, this is that this is for your hotel. For what you have incurred it.
Making the payment priorly.
Prior. This is an advance. Yes, this is a prepayment. Yes, ma'am. So as I gave you the example of suppose if you are conducting a seminar, so you will to a hotel for the catering deposit, you will make a prepayment of, say, if 10,000 is the bill, you will make a 2,000 prepayment invoice, and the remaining you will adjust it with that prepayment and make a payment of 8,000 rupees to that particular hotel. Okay, ma'am.
Okay,
so that is it. Yeah. Then you have your interest invoice. Okay, so this is when we make a payment after the due date has crossed. Suppose you were supposed to make a payment to your supplier today, and you, for some reasons, you're not able to pay the payments, and you happen to pay it after, say, 4 or 5 days or something. Okay, so what happens is if this is an interest, which is a penalty which is applicable. So system will create one invoice for only the interest portion amount apart from the standard invoice. All right, so this interest invoice is only the penalty. So say a penalty, so you have a bill of say 10,000 and you could not pay it as per the due date, and say every day, depending on the agreement that you have with your supplier, each day you know like if you're not made a payment within the due date, so each day you delay it depending on the number of days that you've accumulated, after the due date, it will calculate the interest, put the penalty, and then raise a interest. So only that portion of interest will be raised separately apart from the standard invoice. Okay, you got that point of interest invoice? Hello?
Yes,
Yeah.
ma'am.
Yes.
Okay, fine. And then at the end you have your transportation invoices, which is basically your the invoices for your freight payments. When you ship your goods and all that, you have your freight charges, right? The shipping charges and all that. So that comes under your transportation invoices. Okay, so basically system automatically generates 4 invoices, which are the recurring invoice, the expense invoice, the interest invoice, and the withholding tax invoice. This is usually you predefine it in the supplier system page itself. That's the reason it will automatically generate these invoices. Right? Okay, so let's go to the next slide. Options for creating invoices. Okay, so basically we have 2 options to create an invoice, which is your using your spreadsheet, and invoices from a scanned image. So you can create invoices in a spreadsheet by using the create invoice in the spreadsheet task. So from the spreadsheet, you can also submit the import process. So this is a great option which is used when we want a high volume of invoice entry. Ma'am, I was, if you remember, I was mentioning about all these FBDI and ADFDIs, right? Wherein you can, save all your invoices in spreadsheets, and then you can load that data into your system with the help of the spreadsheet. Okay, so this here you can use this feature of a spreadsheet, such as copy and paste or hide or unhide in this spreadsheet option of creating invoices. All right, and then you have this invoices from a scanned image. So this is basically an integrated invoice imaging solution for Oracle Cloud, which provides a scanned image import or character recognition and automatic invoice creation. So in addition, the solution routes invoices, okay, with the exceptions to accounts payables personnel for review and completion. So basically, to use the integrated invoice imaging solution, you need to have a designated email account, okay, to send the invoice images. You get an email account when you sign up for the Oracle Cloud application service. Okay, so once you're registered for this particular service, you'll be sent a unique email ID through which you can scan the images and process it. Okay, so after you have the email account, you prepare the invoices for processing. Okay, so if the business process is to receive invoice images from your supplier, you will let them know your imaging requirements. Okay, then the suppliers can email the invoice images directly to the designated email account. Suppose if you receive paper invoices, okay, the particular personnel will prepare the images of the invoices by scanning it and sending to this dedicated email account. All right, and then once the images are sent to the email account, the imaging solution retrieves them for further processing. Okay, so the solution checks for a new image every minute and creates invoices from the images. Okay, so you import the images wherein the system recognizes it. It then stores into your database. Then it processes and then it makes the payment. Okay, so after the rest of the invoice processing tasks are finished, such as the validation and approval, the invoices are ready for payment. In case if there are any validations required, or if there are any errors or anything which needs to be rectified, it routes back to your personnel. Okay, then the person who is assigned the edit to make necessary changes, the personnel will do that, and then again they push it to your pay invoices section, where the payments of this invoices will be made. Okay, so this is basically your invoices from a scanned image. So these are your two options for creating invoices. One is using the spreadsheet, and the other one is invoices from a scanned image. All right, so any doubt here, anybody?
No, ma'am.
Okay. So there is another option where you match your invoices to your purchase orders, okay, which is called as the two-way, three-way, and four-way matching. Okay, so one of the fundamental controls, in payables is the PO match, the purchase order match. So this simply means that the invoice you enter. One second, excuse me. Yeah, sorry for that. Yeah. So as I said, this simply means that the invoice you enter in the application is matched to the purchase order. So if the match is not successful due to an amount variation or quantity variation, the invoice is kept on hold. Now, when the invoices are on hold, those invoices cannot be paid. Okay, so the hold has to be resolved before you can pay the invoice. So the PO match functionality ensures that you only record and pay invoices that are eligible for payment. So it is a very simple but a powerful feature that prevents the organization from paying incorrect and fraudulent invoices. So now let's look into the different methods of PO match. Depending on the business requirement, one should perform a two-way, three-way, or four-way matching. So what is a two-way match? See, a two-way match basically verifies your purchase order and the invoice information, okay, within your tolerance level. Now, what is a tolerance level? This is a window. Tolerance level is a window wherein you define the matching and tax tolerances you want to allow for variances, okay, between your invoice and purchase order, or your receipt and tax information. So here in a two-way match, you match your purchase order, which has to be less equal to your invoice quantity. So once it is matched and it is equal, then you will send it for your clearance of your invoices. Okay, this is basically used where there are no receipts. You do not ask for any receipt, like suppose your repair services or your rentals that you pay, you don't ask for those receipts. So there you use the two-way matching of your invoices. Okay, then any doubt here? Did you get my point? The two-way match.
Ma'am.
Okay, then we move to the three-way match. So in the three-way match, there is an additional criteria which is added to verify, which is the receipt and invoice information match. Okay, with the quantity tolerances again that you define. The quantity billed must be equal to the quantity received. So it's usually used for purchases of finished goods for which you have a receipt. Okay, so you have a purchase order, then you have an invoice where you match the purchase order with the invoice, and you match that with the receipt that you have received. Okay, so this is basically a three-way matching. And once all these three criteria have matched, you release your payment, okay, to your supplier. Then comes the four-way match. Okay, the four-way matching adds yet another criteria to verify, which is the acceptance documents and the invoice match within your quantity. Like here, your invoice is matched with your purchase price. Invoice price is matched to your purchase price. Your quantity billed will be matched with your quantity ordered. Your quantity billed will be matched with your quantity that you have received. Hello, one second. Yeah. So your quantity billed will be matched with your quantity received, and your quantity billed will be matched with your quantity accepted. Okay, suppose if there are any, as I said, there are any damage to the products, or maybe they have given us a lesser number of products or anything like that. If you don't have any of those problems and you have accepted the goods and services, so all these four-way in I mean, your purchase order, your invoice, and your receipt and accepted documents have all matched, then finally you will release the payment to your suppliers. So this is basically a four-way match. Okay, so this was another way of matching and releasing your payments to your suppliers. So this was it. Any doubts, anybody? Hello?
Yeah, ma'am.
Yeah, it's all clear.
Yeah, ma'am.
Yeah, yes, ma'am.
Okay, fine. So this was for today, and tomorrow maybe I'll take a little bit of theory, and then I'll go into the practicals and configure the accounts payable. Okay. So that would be the thing. So in case if you have any doubts, you can please go through. Anyways, I'll be sharing the videos and the PPT in the group. So if you have any doubts, you can get back to me, right? Okay, so that's it for today.
Okay, ma'am.
Okay, okay then. Thank you.
Thank you.
Yeah, thank you. See you tomorrow.
Thank you, ma'am.
Okay, yeah, thank you.